let's look at the metals and the mining ETF. First off, read this disclaimer carefully. This is the ETF in question, the XME, very liquid, metals and mining ETF. The reason why it is very interesting is because we are currently in May, and this shows you the months at which it closed higher than it opened. June and July are characteristically the best months to be invested in the XME, closing higher 75% of the time. That is interesting. Let's here look at the charts using weekly data points going all the way back here to 2006. Here, of course, you have the big bear market, the financial crisis. The XME is one of those ETFs that had a major rise after the housing bubble. Then it reached a very early high in 2011, and it's been sick ever since. This is something that is very important to take notice of. Many markets are much weaker than what is reflected in the S&P 500. This obviously looks rather sick. Though there's been some recent improvements. Here you have a very clear bearishness. We recently here on the weeklies made a double bottom. Boom, boom, a double bottom. Before this major rise, we had a double bottom as well. This is a very nice double bottom in the sense that the lower end, the lowest end of that bottom is to the left, while it is a bit higher here to the right. Of course, it is not like double bottoms work all the time, certainly not, but so far we are seeing buyers step in, and the markets have become increasingly algorithmic, and these patterns are the things the algos will scour for. Hence, there is buying pressure when these formations are formed. Another interesting phenomenon is if we look at the accumulation distribution line, which shows us the buying pressure. You can see that it was actually lower here than it was here, notwithstanding that there's not a huge amount of time between these lows, hence they are comparable. That also is, somewhat bullish. If we look at the RSI, you could certainly make the case that we were abnormally oversold. Here the RSI was all the way down here to 18. If you look at the low here of the financial crisis, it reached an ultimate low here of actually 19. The correlation with the S&P 500 is negative, minus 19%. Looking here at the moving averages, it is certainly expected to see some resistance here at the 20-week moving average. Let's go to the daily data points to see what is going on here. So we've had a relatively consistent and measured rise from these, big crash lows, being able to reclaim many key moving averages. And another change happening is that the green 50-day moving average has gone from being negative to now starting to turn upwards. That's also one of those things that the algorithms will pick up on. We also have a breakout above some key levels here. So all things considered, from a very speculative standpoint, it makes more sense to be bullish on metals and mining at this point. There are some interesting patterns forming up here. The seasonality was also a bit of interest, looking here from 2016 to 2020. We can go a bit further out in other periods, so let's go to like this period here. You can see that June leading up into August, throughout this period from 2012 to 2016, it was a good period for the XME. If we go back beyond 2012, the we are now getting into the period after and also during the financial crisis. Hence, this is a bit of a unique period, but if you look at the behavior here, we were basically stuck here at 40% of the months closing higher during this period. All things considered, looking at the seasonality, there is some clear trend here that between May and heading up into August, looking throughout a lot of the periods here, there seems to be good seasons for the XME. If we go here to Finwiz, you can see that you are paid the 3% dividend. You know, that's nice. That's a decent dividend. If we look here at some of the performance data, it is down minus 31%. And there is a characteristic phenomenon of rotation in the stock market, meaning we have recently seen a major push in the valuations in the technology sector and healthcare and many of those industries that benefited very from the contagion. But when the valuations become too high, there is this rotation into other sectors. And XME, given the current prices, it could certainly benefit from those rotations. So here you have the XME, a bunch of data, assets under management, daily dollar volume. You can see here that the price to earnings, they are high, but they are characteristically high in this industry. The price to book is actually quite good. Value investors prefer the price book to be below 1. 0.71 is there's value here. If we go a bit further down, you can see the composition. Okay, so you got steel, you got gold, which is interesting. You have some of that precious metal exposure as well. Hence, it's not like all in on the base metals. Got some coal, aluminum. If you look here at some of the companies, you got Newmont, you got Tekla Mining, Freeport-McMoRan, they are in the copper business, Alcoa, aluminum, Schnitzer Steel, self-explanatory. Yeah, all in all, interesting companies, and we are certainly looking at the global economy that is in a lot deep trouble, basically. And one of the ways in which you can kickstart an economy, and that's done before, and that is to just have major infrastructure projects. Just get people to work, build all kinds of stuff, and that would be beneficial to the metals and mining. I mean, we do, of course, have other basic materials companies, ETFs, that is. Here is a nice mix. We can see that some of them have run a lot from the lows. Some huge moves here. Yeah, if you look at some of the major economic crises throughout history, one of the characteristic ways to kickstart is definitively just rebuild, refurbish, and make new stuff. Hitler, of course, he did that in a big way during leading up to World War II, which was bullish for the metals and mining stocks in Germany, and in many other countries as well. The rebuilding was like the way to get back to work. Let's now have a quick segment about day trading, because given the highly cyclical nature of the metals and mining companies, looking at gold miners, or copper, all kinds of mining companies, there are of course leveraged ETFs available. It's one of those spaces where it can be particularly interesting to be a day trader. Let's now get into some of the requirements of getting into day trading. First off, you actually need a very powerful computer. This is one of those things that many people underestimate. There's a lot of people who put a bunch of money into getting, multiple screens. That's obviously beneficial, but do not underestimate the importance of having internals in the computers that are of great power. The easiest way to get a powerful computer is to just get a gaming PC. Because of games require a lot of processing power. If a computer can play the latest games, you know that it has the power you need. So that's like the easiest rule of thumb. And also the gamers are very demanding customers, hence you are more likely to get good value for your money. You need fast, stable, and secure internet. And this is arguably the absolutely most important thing. You should be on a low or zero commission trading platform, because when you are day trading, you are making many trades, you will just be eaten alive by commissions. Real-time market data, absolutely essential. Advanced charting tools and news feed. Fast and accurate order execution. This is also very, very important, because some of the low and zero commission trading platforms, they do have more wonky execution speeds, which means that you are paying another kind of commission in some instances. Broad range of order types, super important. Dynamic trailing stops, fixed trailing stops, limit orders, stop loss. These are some examples, but there are many others. You have to be very skeptical though if you are on a trading platform that does not give you access to these more advanced order types, because there's no technical reasons why they cannot implement these things. Hence, it is more the case that they are rigging the system against you, which is obviously not good. Let's continue. Okay, so there are some pros and cons of day trading. One of the pros is that you avoid overnight and over-weekend risks, which can be quite substantial, especially during these very volatile times, where it has been very dangerous to be a bull, but also dangerous to be a bear. Volatility of bear markets are very beneficial to day traders. There are some cons, of course. The many market moving news happens when it's closed. This is why, if you are going to get into day trading, you should ideally be on a platform where you can participate in both pre- and after-market trading. There are some limitations when it comes to gains, for sure, if you can't get access to the pre- and after-market. Commissions, yes, they are the devil. And this is an example of how commissions work. So if it costs $10 per order, to execute an order, meaning basically $20 total to enter and exit, then you need to move $20,000 per order to get commissions down to 0.1%. If you move $2,000 per order, commissions they account for a whopping 1%. That's huge. Commissions, they are one of the most evil inventions on the planet. I think commissions are the primary reason why retail investors underperform institutional players, definitively, because commissions, they make you do so many stupid things. Okay, let's now quickly do an assessment of the S&P 500. Okay, so this is the daily data points, the SPY. We had a huge update yesterday. This was to a large extent due to Jeremy Powell. He had an interview on 60 Minutes, and he was basically stating that the Federal Reserve, they have the market's back. They are going to support it by any means necessary. That was considered to be very bullish. That's exactly what the market wanted to hear. There is of course something to think about. If we do have the prospects of a genuine recovery, why on earth do we need support from the central bank? That's something right. If there is genuine strength here, we don't need Jeremy Powell to support us. Hence, you could make the case that the very fact that we rallied so strongly on the accommodative stance of the Federal Reserve, that is kind of bearish. It would be much better if we rallied very strongly on some clear improvements in the economy. You can compare it sort of like to an athlete. So let's say you have an athlete that is using performance-enhancing drugs, that athlete is not really a good athlete. The drug is sort of like that's where the performance come from. And you could make a strong case that ever since the 2008 financial crisis, the market to a large extent has been on performance-enhancing drugs. Negative interest rates, if we do get that theoretically at least would be very bullish for stock markets. But that would be like the ultimate performance-enhancing drug. It would be just the super nuclear option. And the problematic feature is another factor called political risk. Because if we do see the market roar up to new all-time highs while the economy is continuing to unravel, then the difference between Wall Street and the Main Street will be extreme, which in turn could lead to all kinds of protests, political radicalizations, new kinds of taxes, all kinds of political mayhem. Hence, the overall picture of the future for the market is one of turmoil. This is why it is super important to be very careful. Obviously, you do not want to fight the Fed, but do not think that because of this, you could buy, triple leveraged call options on margin or something crazy like that. Because that's the moral hazard of what the central banks are doing. In a healthy market, you have a balance between the bulls and the bears. This, of course, is going to intimidate a lot of the bears. Many people are joking that, oh, I'm never shorting a stock again. That is very dangerous, because when everyone is turning bullish out of either genuine bullishness or just frustration, that's when the market is going to turn the other way. Whatever you do, of course, let the trend be your friend, and we did see some very interesting seasonality when it came to the XME.